This is Trepp Week in Review for the week ending November 10th, 2023. I'm Haley Keene with Trepp, a data, modeling, and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Chief Product Officer. This week, it was all about interest rates. What the Treasury market gives, the Treasury market takes away. Early in the week, investors were cheering as the yield on the 10-year fell to below 4.5%, and credit spreads tightened noticeably. That gave stocks a big lift and raised hopes that the constrained capital markets might loosen up. But that all changed on Thursday when weak 10-year and 30-year auctions stopped the rally in its tracks. So Manus, was last week's rally the start of something, or was it one big head fake?
Well, the one thing we do know at this point is just how outsized the market's reaction is to even modest moves in the Treasury yield curve right now. The market saw a really explosive 7-day rally in both Treasuries and stocks spanning the middle of last week until about the middle of this week. We hinted at it last week during our open. We had said that the 10-year Treasury, which had grazed 5% maybe 10 days ago, was falling noticeably. We thought that that was good news. Credit spreads were contracting impressively. We thought that was great news. I think last week we said that the residential 30-year mortgage rate, the average rate, had come in about 45, 50 basis points, which we thought was a great sign. It was, nobody's popping courts at that level. Nobody at the sales brokerages or the lending brokerage houses are, doing victory laps, but it was reason for optimism. That rally that we referred to last Thursday really extended Friday, Monday, Tuesday, Wednesday. The yield on the 10-year fell below 4.5%. Credit spreads, especially for riskier assets, BBB minus, really continued to compress impressively. In the CMBX space, we saw some tightening in some sub-indices of maybe 100 basis points over the course of a couple of days. What this meant was that rally in the 30-year residential rate actually expanded from about 50 basis points to 75, 80, 85 basis points. I think the 30-year mortgage fell below 7.5%, which was terrific. And the 5-year, or I should say the 15-year mortgage, was below 7%. So all of this boded well for the commercial real estate markets. Rates were falling, spreads were contracting, people were feeling modestly better about things. And then we run into a brick wall today. And that brick wall was Treasury comes out with 10 and 30-year auctions, really poorly received, not a lot of interest in the paper, and rates go shooting up and the rally's over. So today, stock markets fall. I think the yield on the 10-year was up 13 or 14 basis points back above 460. The 2-year was up 10 basis points back above 5. And I think the 5-year got the worst of it. I think it was up 16 basis points today. So I think that whatever optimism was built over that 7-day rally has been tempered today. And now we all sit on our hands waiting for whether or not this is a one-off, one-day effect, or if rates start to climb anew.
Yeah, I think, Haley, the lead in on the head fake is kind of where I would describe this. I mean, everything you just walked us through, Manus, it's just interesting when we look back on these things in retrospect. Like, you would feel really good last Thursday, Friday, Monday, Tuesday, everything looks great, but it's just amazing how quickly those things can be stymied. And we saw that today. Our friend Donut Shorts posted on Twitter today talking about the 30-year auction, said the tail on the 30-year auction is worse since 2011, which, as you described, reversed a lot of the optimism that we saw building the first part of this week. So, it's just, and we've said this multiple times, it's almost a day-to-day business, week-to-week, minute-to-minute sometimes, where certain things that we don't think will set the markets off have, both positively and negative. And this week, I think it's aptly described as a head fake. We'll see what happens. I wouldn't be surprised to see another reversal heading into next week. I wouldn't be surprised either if things continue to come back in from the optimism that we saw at the beginning of the week. So it'll be interesting to see. I would agree with you as well that it seems like everyone's kind of waking up every morning and checking that 10-year. Everyone's waking up and wanting to see what those 30-year mortgage interest rates are. Those have kind of become a focal point for the markets as a pretty good indicator of where we're at. So on the residential side, the mortgage interest rates haven't really impacted pricing, good or bad. And I think what's kind of scary is if residential mortgage rates dip below 7, like you mentioned on the 15-year in that 6 range, with the constrained supply that we see in the market, it may drive pricing up even higher because people are going to take advantage of that reprieve on the interest side. So I think we're in an interesting part of the calendar with the holidays coming up and things slowing down. This week, though, has not been slow at all.
Yeah, it's funny. I was doing some interviews earlier today, and it was before the auctions, and I was talking to these reporters. They were asking me, would there be an impact in the CMBS market on issuance in Q4? And I said, no, things don't react that quickly. Warehouse lines are built and loans are made and they sit in warehousing. And I said, it's too late in the quarter for it to impact Q4, especially for a quarter that usually ends by about December 15th. People start packing up long before year end, their deal making. But I said at the time, and this may not age well, that there could be momentum building for a better than expected Q1 if rates continue to fall. And as we know, by mid-afternoon today, that narrative had changed dramatically. But what I would add is that we don't know what's going to happen tomorrow. And certainly, this market can go anywhere. But the last time we had kind of a disappointing market was just like 3 or 4 weeks ago. And that was what started the march in Treasury yields from like a 450 10-year all the way up to that 5% level. So that last week auction had legs, and it really did push up yields for more than a day, and it marched higher. So maybe if there's a lesson to be learned today, it's if you have a chance to lock in something that you really can lock in, maybe you want to do so before this march goes further north and that 10 years back at 5%, but hopefully not. But you talk about watching the TV, I made this remark. I talked about Haslinda Amin, who is the woman who's on Bloomberg in the evenings. I always know when there's more volatility because I'm putting on Haslinda at 10 o'clock at night to see what's happening in Hong Kong and Australia and so forth. And I can go weeks without watching her if the markets are reacting positively. But I know I'll be watching her tonight. I'll be seeing what that 10-year is doing, and maybe she'll see an uptick in her ratings. We'll see.
Yeah, I think they call that the Manus effect. So the volatility is good for their viewership, and you're leading that charge. We did have a couple of additional macro things that we didn't get to talk about last week because we did the pod on Thursday. So the October jobs report was released last Friday. So I just want to quickly hit on that. And then I know, Manus, we had some WeWork stuff. It's been a pretty busy week for WeWork. But the October jobs report came out. Probably a good thing. The market showed a cooling labor market in the U.S. Several sectors had minimal or negative growth. And the add of jobs was about 150,000, which people have been calling meager. Not bad news there in terms of what Powell's hoping to achieve. Remember back November 1st, ADP reported 113,000 private payroll jobs were created in October, which was below the consensus expectation of 130,000 jobs. So just wanted to get that in. And I know, as I mentioned, we've had a lot of coverage on WeWork.
Well, the WeWork story, not unlike Sears and JCPenney and other bankrupt entities we've seen over the last decade or so, took a really long time to play out. We mentioned in our commentary that we started building lists of WeWork exposure as far back as late 2019 or early 2020, before COVID and long before this bankruptcy filing was out there. Most people know the narrative. Maybe you've seen the HBO movie on this that they made about this whole process. Adam Newman backing up the truck, taking lease after lease after lease, more and more space every month, growing the company, it being valued at $47 billion at one point. The Wall Street Journal breaking the article that along the way he had sold $700 million in WeWork stock in the private markets. That really sent people jittery. And that was more than 4 years ago. And people have been following that story ever since. Sam Zell, may he rest in peace, he made the remark that this business model never works. And he says, you lease short and you borrow long, whatever that model is, whether it's investing in a bank, not matching assets and liabilities, or if it's in the commercial real estate space, it doesn't really work. And he was right. And what we saw since August, WeWork came out with their going concern announcement that sent people scurrying anew to see where their exposure was. We mapped it at the time. We're lucky we have a extraordinary research team here that does a lot of heavy lifting every day. They put out a list which showed every CMBS loan where WeWork was a tenant. So people have known about this for a while. And, the other shoe dropped this week with the bankruptcy filing, 65 US leases being rejected, a few more in Canada. And that research team that I referred to, they mapped those lease givebacks to CMBS loans. And it's not chump change. There's a lot of big New York, 40 leases in New York being given back, another handful in San Francisco, others in Atlanta. It's a lot. And some cities, it'll be a flesh wound. In other places, it's going to leave a deep bruise. But it is something, I made this remark. I think Haley took it out of my prepared remarks that we wrote, where I said, if you didn't know WeWork was coming and you didn't know where your WeWork exposure is, you probably shouldn't be in the CRE or CMBS business, right? This was flagged so long ago by us and by others that if you're only now waking up to this risk, shame on you.
This is the Manus After Hours edition of the podcast. But I tend to agree. I mean, this, to your point, this isn't really news in the sense that it's like breaking. It's what we knew was coming. And unfortunately, for the markets, it's been talked about so much that at this point, it's not even really a shocker. I mean, obviously, the exposure that we put out, the downstream implications, like those things have negative impacts, and that part is newsworthy. But just the business model, everything about it, as you laid out, just doesn't work. And now we know for sure it doesn't work. And so just to give some context, and again, we've shared a lot of this on Twitter. So if you haven't seen the tweets, you should check them out. If you'd like to see some of this data, email us at podcast@trepp.com and we'll send you some of the data. But, just to give some context, on the properties that have WeWork exposure in the data set, the average lease exposure to WeWork is about 32%, which means WeWork leases about 32% of the total building square footage. We did an analysis that said of the $750 million in loans with exposure that have challenges, if they were to default next month, that would increase the overall office delinquency rate by 45 basis points. And so, it does provide some context that this is definitely like a move the needle moment. It's not going to send anything red line. It's not going to blow up the market. But I think you put it well, Manus, when you said for some cities that are already struggling, that maybe have a bigger exposure to WeWork, this just puts a lot of extra downward pressure on that market, and it creates another really low comparable for the markets to have to digest in already struggling markets. And some of the office markets where the exposure is minimal, this is probably just a blip on the radar, and like those market participants will be glad that this is no longer discussed and they can move on from WeWork. But this is something I think for all of us, unfortunately, will probably stay in the news cycle. This isn't the last we've heard of WeWork, especially if Adam Newman comes back and buys them out of bankruptcy. And I think there's a lot of people rooting for that, and I think that would be chaos.
That would be wild. This whole thing about getting in front of issues before they happen. What we had this week was, I'm just pulling this out as an analogy, and what really excellent practitioners of risk management do. Citibank, as part of their earnings, came out and said they were going to be cutting 10% of their workforce. Savvy real estate investors, whether they're debt investors, property owners, they are reading these news stories and they're saying, okay, how do I get in front of this issue now? Do my credits have any Citibank, Citicorp exposure now? Citicorp may wait 24 months, 36 months to close offices, but they're already looking at this today. In fact, we put out a Trepp Wire, and this is why we're at Trepp so proud of Trepp Wire, that we highlighted a story for people where there was both WeWork and Citicorp exposure, and Citicorp had a lease that has a termination option in 2025. The practitioners that are Hall of Fame or perennial all-star practitioners in the space are finding those things before they take place. They're not waiting till Citibank or Citicorp announces these closings. They are moving on it early. But let me ask you this question, Lonnie. This is kind of a curveball question for you, but WeWork rejected 65 leases. Now those owners know the property space is coming back. They have nothing to worry about anymore. They know their job. Their job is to re-tenant their space. They're not getting another dime. right? It's a known thing. Other tenants, they still have WeWork. WeWork has said, we're not rejecting this. We're going to keep paying this. So they live in this nasty period of time where they may reject more, or they may stop making payments, or Chapter 11 may become Chapter 7. Which would you rather be? Would you rather be the guy who knows he's got work to do and he can roll up his sleeves and get going, or would you rather be the guy who says, well, at least I'm still getting a check every day. Thank goodness.
Yeah, I think in a typical market cycle, you would rather know definitively they're not here, they're not paying, we're going to re-tenant the space. In today's environment where re-tenanting the space is not a given and is really a challenge, and in some markets probably not even possible, given the work from home and lack of office utility, you're probably taking your chances if they're saying, like, look, this isn't part of the initial lease rejection. You're counting your lucky stars and taking every dollar of cash flow that you can from them to keep your building, and hoping that in the interim interest rates change, the market dynamics shift, people come back to the office, et cetera. It actually buys you a little bit of time, hopefully, for those macro conditions to be more favorable to office. I don't think that probably happens in the time frame that we're talking about here. And I do think, for your point of it maybe going from Chapter 11 to 7, like, though none of that is a great place to be. Like, none of these options are great, outside of the fact that a lot of the WeWork spaces are in really nice buildings in really good locations. We do have some narrative that the high-end buildings in good locations are still seeing some leasing activity and even some strong rents. So maybe these spaces, which have pretty good finish out, maybe you can be repositioned and re-tenanted. But I think in today's market, you're probably okay if they're staying, so long as they keep paying, and hoping that the macro environment changes to your favor.
That sounds about right. I think, when Sears went down this path, I think people were clamoring for Sears to reject these things because there was an opportunity to put a higher end tenant in some of these malls. But I think you're absolutely right. Given the condition of the market right now, we are, I think one in the hand right now. If you can keep collecting a check every month for another 6 months or a year, you're probably better off.
I think what's interesting, though, is I bet the lenders, like, they're not giving you any credit if WeWork is still paying. If you're up for refi and you have WeWork and you're like, well, we weren't on the list, and so they're still paying. I doubt the lenders are looking at that as a viable tenant in their due diligence.
That's a great nuance that you brought up there, that how you feel about where you sit probably has something to do with how much time you have before your loan matures. That's a great point.
Okay, so we could break it up with some positives before we get back into crabgrass, because we have a few good news for office stories, right?
We are going to run through them. We do have some green shoots in the office space. Let's take them one at a time. Walmart has agreed to take 700,000 square feet of sublease space from Meta/Facebook in Sunnyvale, California. This is in the Moffett Towers complex. Google's there. I believe Apple has a lot of space in that area. It's a real tech hub. But as we know from Trepp podcasts and from other great reporting from the people that we source every single week, the tech companies have been big givers back of space in 2023. That included Meta. And so a green shoot in Sunnyvale with Walmart taking 700,000 square feet. In Virginia, this is another terrific one. Michael Niebauer of the Washington Business Journal, he was reporting that Amazon has extended leases in 2 Crystal City offices. Why did this catch our attention? Well, we know that Amazon was opening space at HQ2, a big tower in that location. We thought that some of these Crystal City offices may not get lease renewals. Now we're finding that Amazon has renewed for 5 years at 1770 Crystal Drive. That's for 260,000 square feet. And they renewed for another 88K at 241 18th Street South. Those 2 leases represented 80% of JBG Smith's leasing activity in the last quarter. So a green shoot there. I think that's all I really have in the really positive side. So it wasn't a terrific week for green shoots, but better than nothing, I suppose.
Yeah, so I looked up, man. It's the Moffett Towers are part of a J. Paul company portfolio. So shout out to the J. Paul folks there. And Given all the news about AI tenants leasing space in Silicon Valley, maybe we're going to be hearing something from Walmart in the AI space here soon of them taking that lease space down. So good news there, and I know you have some mixed green and some crabgrass to report on as well.
Yes, let's keep our fingers crossed that whatever Walmart does in AI works out better than their self-checkout. I am not a fan. That whole thing, I don't think I've ever been through the self-checkout without having to have that older man or woman come up with a card where they have to swipe, they have to enter their key code and get you through the process, right? It is never, ever seamless. So Walmart, I guess it's not Sam Walmart anymore. I'm not even sure if Alice Walmart is still at the reins there. But if you're listening, and I know you do, please, take our comments to heart. I will throw in one more green shoot out there that I can't give away too much on this, but I'll give a little bit. There was a deal in the market today. This is new issue pricing, a 5-year deal that hit the market price today. I think probably still under password protection. Conduit deal, about $500 million. And the green shoot there was among the top 10 loans, 2 offices were in that list. In fact, 2 offices among the top 7 or 8. One is a suburban Charlotte, North Carolina office, north of $50 million in loan proceeds. It looks like the loan rate on this thing is about 740, so you're probably talking 250 over the curve on a 62 LTV loan. The other one, not a terribly well-loved market. This is in Oakland, California. We're talking about a $35 million loan. Here's significantly underlevered, a DSCR of over 2, LTV of 33 for an occupancy rate, which is firmly in the 80s. So I wanted to bring these up without giving away too much, just to show that new lending is not zero, right? There's this narrative out there that office owners cannot get a sniff ever. And while getting a sniff is really, really, really hard, it's not zero. For those guys that are willing to go super low leverage, have great rent rolls, high credit tenants, and long duration on their leases, there is an opportunity to tap the markets. The rates are high, terms are not great, but it's happening. It's happening in small doses.
Yeah, that's great to hear. And I think it fits in the narrative we've been talking about. Issuance is tepid for the office sector, but it's still there. Unlike some other times, the great financial crisis and others where there was no liquidity. And when we said no loans, it meant no loans. Here, to your point, good quality assets with good tenants can still get deals, just probably not at terms where everyone feels like they're getting a win on that. Lenders, yes. Borrowers, no.
Yeah, nobody's popping corks these days. We know it. We know our broker friends, our originator friends. It's tough sledding. We want to encourage people without being Pollyanna here, and hopefully we do so. Going to some of the crabgrass here, these are 2 stories that revolve around Santander. Consumer USA, Santander is the big foreign bank that operates extensively in the U.S. Out in Mesa, Arizona, Santander terminated a lease. They had a lease that was to end in September 2026, but they gave notice that they intend to terminate that lease in August. That makes a $19 million 2016 CMBS loan one to watch. This is something that we broke in Trepp Wire a couple days ago. Another story about the firm, Olivia Lukenmeyer of BizNow reported that the firm could shed more than 37% of its office space in the downtown Dallas office building that has its name on the building. So Santander is the big named tenant there. 1601 Elm Street in Dallas is the property the firm is looking to downsize from 400K to 250K square feet in that market. In the leasing space, one more piece of crabgrass, and then we'll get to a couple of sales. This is the kind of thing that is kind of like the 2x4 hitting you in the back of the head. Story comes from Bloomberg Law and The Real Deal as well. Law firm Strook and Lavin announced it will be dissolving. They lost a wave of partners over the last couple of years. They couldn't come up with a merger. The firm goes back almost 150 years, and the law firm had almost 200,000 square feet at 180 Maiden Lane in lower Manhattan. So this is one of those things that keeps property owners awake at night. You never see this coming. You think 150 years in the business, law firms been paying their rent for more than a century. You think they'll be there forever, and then they go and dissolve. And that's one of those headlines that makes commercial real estate so lumpy.
Unlock a historic mall investment opportunity with Spinoso Real Estate Group's proprietary platform. Their expert team excels in identifying unique opportunities and conducts rigorous due diligence. With a proven track record of operating over 86 malls and 74 million square feet, their turnkey operating platform is poised for strategic execution. Partner with Spinoso and seize this institutional historic opportunity. To learn more, connect with the Spinoso team at the CREFC Miami conference this January.
No, I think it's time to fire up the engines. And what do we call that, Haley? Broker start your engines. Let's talk about some sales transactions.
Well, I don't know, Lonnie. You may have stepped in it with that one because my sales transactions are not exactly great ones. Keith Loria from Commercial Observer, Virginia Hospital Center acquired a office in Alexandria for $21 million. This is a 145K medical office building at 3601 Eisenhower Ave. Why was this not a happy story? This is a 43% cut from what Monday Properties paid for the asset in 2018 when they bought it for almost $38 million. Another one in Charlotte, this comes from Jordana Rothberg, commercial property executive, says that AEW has sold a 108K square foot office in Charlotte. The buyer was the Perkins Fund. The asset is Three Water Ridge, which is fully occupied by Walmart. Why did this catch our eye? This asset traded for $35 million in 2016. The sales price now just $15 million. So more than 50% haircut. Something tells me that while Walmart is occupying that building, that may be a short duration or short remaining duration lease, which may have something to do with the fact that this has been so heavily discounted. Two more stories I'll run through that are not sales related. This came out this morning from Commercial Observer. They reported that the $670 million 230 Park Avenue loan has been sent to special servicing. The property is also known as the Helmsley Building. The Helmsley were big real estate players in the 80s. I forget the husband's name. The wife was Leona, and she was real tabloid material for many years. She was cover of the New York Post, apparently for mistreating her employees. She got a bad rap. Maybe it wasn't a bad rap. Maybe it was an accurate rap back in the 80s. So she was always on the cover of the New York Post. This property has since sold, but the 1.4 million square foot office loan is now in special servicing. My guess is this is all cap related. The loan matures next month. Extension options could push the maturity to 2026. But higher interest rates have squeezed out all profits on this loan entirely. DSCR is under 1.0x now. 3 of the top 5 tenants have leases expiring in 2025. And in order to get that original loan, the owners had to get an interest rate cap with a LIBOR cap of 2.55%. We know LIBOR or SOFR now is above 5. This cap is going to be extraordinarily expensive for the owners of this property to do it, and hence, in my opinion, that's why the loan is now with the special servicer. The property also has $125 million in mezz debt, and I have to cite Kroll. They were referred to in the Commercial Observer article for their news of the special servicing transfer. So good on them.
Yeah, so Haley, we need to revise. When we started our engine, we started hearing an engine knock, and our check engine light came on with those sales. But listen, for the buyers in those activities, they're hoping they're getting a steal of a deal and they're going to be able to reposition those assets. So seller not happy with 43 and 50% reduction in price, but the buyers obviously are hoping that they have some upside there. So we'll see. I think the 230 Park Ave, man, that's kind of like dead office walking, nothing about that sounds good. Huge loan, significant mezzanine debt, very favorable financing in the past, which is not going to be replicated now. DSCR and occupancy that's really tight. I just think they're going to be up against it in that example.
Yeah, the one thing they have going for this in that market is really you could throw a baseball from Grand Central Terminal and hit this building. I think in the winter you only have to be outside for about maybe 200 feet, You can go right from Grand Central into this building, and that's one of those assets that may save this building. And especially now that Grand Central Terminal has people coming in, not just from Westchester, but also from Long Island, that is the one thing that could really backstop this particular asset. I'm going to take a quick detour for 1 second before we move on to another property type. This has been something coming at me via email and Twitter from a lot of different people having to do with distress. People that have never bought distressed notes, have never trafficked in this market, but think that there's opportunity. You talked about it, Lonnie, people coming in there and buying things and repositioning them. I was talking to a broker earlier today who said, I was free to share with any of your listeners their offering document for something that they're selling, which is in deep distress. This is New York City mixed use office and retail. And for somebody who's in this market, you know what an offering document looks like. But for somebody who's a newbie who says, I want to start seeing what something looks like, I've got authorization to share this with you. And if you have interest in seeing what something like this looks like, and you're a newbie to the market, please let me know and I'll share it with you. And you can get a sense of what kind of color you get when something is on the market that is being shopped and is perhaps dented, presents a low cost opportunity. So let us know.
And in multifamily this week, we have a story about some Texas apartments that were sold.
It was a decent week for multifamily. I'm not going to go through all the transactions. We did see several sales between 50 and 100 million. I'll try to go through them next week. But one that caught my eye was in Lonnie's neck of the woods. This is a trio of Texas apartments that sold for in the $90 million range. Lonnie can give some color about this. This was noteworthy for two reasons. Reason number one is the buyer of these properties revealed the sales price. As Lonnie mentions often, sales are frequently done without a sales price mentioned. It's a non-disclosure state. Here we got some color on the acquisition. That was one reason it was worthy of pod mention. The other is it fits the narrative of what we've been talking about for many weeks, which is this sale was done with the assumption of a $68 million CMBS loan. The loan had a rate of 3.8%. This now means that the creditor has changed, whoever owns this particular deal, which is in private label CMBS. It's now a different sponsor, but otherwise the loan should perform as it used to be. This is a terrific outcome as long as the new creditor is creditworthy. We assume that they are. I believe that they will continue to service this loan going forward. And I think we'll see more and more of this as people use that assumption option to get sales over the finish line.
Yeah, that 3.8% fixed rate debt's an attractive acquisition target, and you can do a cash equivalency to see what that does for these purchases. But to your point, man, it's Texas being non-disclosure. It's rare that you actually get reported sales prices, but on these transactions, the sales prices were public. So the three assets include Stone Creek Apartments, which is located in Katy, Texas, and that traded at $27.8 million. Included Treehouse Apartments, which is located in Austin, Texas, and that property traded for about $48.9 million. And then Waterstone Place in Stafford, Texas, which was the lowest sales price at $16.1 million. And these were purchased by Disrupt Equity, which now has what they're calling as 800 million in AUM at this point. So, they feel like these assets give them upside potential. They obviously like the favorable financing, and with their headquarters in Austin, they really like the location of these properties relative to where they're headquartered at. So it'll be interesting to see how these continue to perform, as you mentioned, for the CMBS side of the business. On these loans, it should be business as usual, supposing they continue to make payments, and good transactions on the multifamily side. A nice trio of sales here in the Texas market.
I mean, we saw these things sell for, like I said, 90, 92 million, something like that, whatever the number was. But this loan has a number of years to run. This has 75 more months to go. So, more than 6 years worth of payments left on this thing. You're getting a 3.8% market in a 6.5%, 7% rate environment. That's real money, I think. Had this been an arm's length transaction with new financing, you have to think that that number is above 100 million. I'm not going to ask you to take off your socks, Lonnie, and do all the math, in real time, but I would have to think that the price would have been significantly higher without that loan assumption.
Yeah, and Manus has seen me do math before, and yeah, fingers and toes are definitely part of the operation there.
Actually, I should
They
I
should
should
go the
point
other
the finger
way.
at myself. It's the other
Yeah.
way around,
Yeah,
right? They probably paid more for this. Oh, shame on me. Oh my God, I'm the one who's got to like stop wearing socks.
And let's talk about the hotel market. We saw a sale and a loan refinancing this week.
Yeah, the refinancing was a really great story. This goes back to the new issue market. I referred to it 10 or 15 minutes ago about office deals getting done. This particular story is about the Marriott Philadelphia downtown. Philadelphia has had its problems, quality of life issues, office property seeing contractions. What we saw this week was that particular existing property being refinanced. So this is a huge property, by the way, 1,400 rooms. It's located at 1201 Market Street. The asset backed a $192 million CMBS loan that was spread across 3 2014 deals. The loan was slated to mature in February 2024, and now it'll be refinanced. That loan from 2014 should pay off either this month or next. For the trailing 12 months ending in June 2023, the DSCR on the existing loan was 1.63x, occupancy 53%. And one of the nicest signs of the strength for this asset, the latest appraised value, which is coming through in the new deal, is more than 25% higher than where this property was appraised in 2014. So this is not one of those stories where it's a cash-in refinancing or we've seen value flat over 10 years or value degradation. We've actually seen nice appreciation in a market that has been just okay for commercial real estate in the last couple of years. And for those looking at pricing, don't quote me on this, but I think it was done at a level which is give or take 300 basis points over the curve, something like that. So I'll try to come up with a more bona fide number there. The other thing we saw was in Louisville, Courtyard Louisville Airport Hotel sold for $15.2 million. This is an airport hotel. The sale price was $101K per key. And that particular hotel backs another 2014 CMBS deal.
Yeah, it's really great to see the Philly hotel. We've kind of seen Philly get beat up on the office and even some of the retail side of the house. And so it's great to see that hotel deal get done. And to your point, seeing the increase in the appraised value in that market. So that's a really great story. And Louisville, as we mentioned a couple of weeks ago, I was just there. Seems like there's a lot of activity in that market right now. There's a lot of stuff happening on the battery plants and EV stuff in that market, which has really impacted the industrial space positively. But you're starting to see some of the other downstream benefactors of that hotel being one of them. So great on that side as well.
And something else that usually is interesting to our listeners is our loan payoff report. We just released the data for October, and we'd be happy to send that out to anyone who requests it. But can you guys run through some of the highlights quickly?
Yes, this is a study we've been doing. We have a longtime client who's been with us through the 90s. During the great financial crisis, they suggested that we start creating a metric for what percentage of the loans pay off every single month that have reached their maturity date. What is the likelihood of extension? It's very important for people that are buying or selling front pay AAA bonds at either discounts or premiums. Right now, everything is discounted. It's also important for people that trade in the interest-only space. So we've been tracking this for a long time. And when the markets are functioning well and liquidity is plentiful, we normally see between 60 and 80% of these loans pay off at their maturity date. When the markets are constrained, the numbers can be really puny. In the beginning of the COVID period, we saw sometimes those numbers in the 20% range or 10% range. But when things are constrained, they can come in the 30s and 40s. And we've seen this now for all of 2023, that the markets remain constrained. Anything under 50% tells you that borrowers are having trouble refinancing. This month's number was 46%, which is modestly better than what we've been seeing. We've been seeing a lot of 30s, high 30s, low 40s. This is the highest reading in 4 or 5 months, but certainly nothing to get excited about. It's kind of like those PM9 numbers, where if you're above 50, you're feeling pretty good about it, about things in either manufacturing or services. If you're above 50, you're saying we're in expansion mode, and if you're below 50, you're in contraction mode. That number is pretty good for this too. If you're below 50%, you're in a constrained CMBS market, CRE market, and that's where we've been living for all of 2023.
1 month doesn't make a trend, as you mentioned, Manus, but it's good to see an uptick. And if you get the report, you'll see some of the commentary, but the largest loan not to pay off on this was $164 million Stonetown Galleria. And we have some additional information in the report that you could delve into.
All right, so some shout outs this week. We got a nice LinkedIn post from Brian D and Matt H, who were sporting the new Trepwire podcast t-shirts that we sent them. So thanks for sharing that. Sonia S commented that she loved this and the pod. So I said we'd get you a shirt right away. You just have to send me a message. And Czar H said the Trepwire podcast is fire. So thanks, Brian and Matt, for sharing that and getting some of our listeners commenting. Brett W said you guys do a great job. He's a loyal listener, and he congratulated Lonnie on the Rangers win. And we're also going to be sending him some of our delinquency data. Alexandra C is a longtime listener, and she said we always have great stuff. Marco M is a big fan and requested some of our information and our quarterly data report. Howard is a loyal podcast listener. And then we have a loyal listener on our YouTube channel. So we post our episodes on our YouTube channel. They're still audio only. But Tom said office, lodging, and mall REITs are enjoying the change in risk sentiment. New York City vibrancy is back, and thanks for the informative podcast. And Oz listens to the podcast every week. He's an old friend, and he wanted to remind us that he's still there, so thanks for reaching out. On Twitter, Jason C said the Trepwire is the top pod in the industry. He said just wait till Lonnie puts on the Pat McAfee tank top. And that he thought last week's episode was especially good. We are the first to claim that malls are back.
Yeah, it's been a pretty good, quarter and a half for malls. Has been pretty good. We're measuring that on a very, very steep curve. Hopefully the November remittance cycle will reveal some more positive stories there. But I have my own kind of detour shout out from last night. So I'm sitting around about 5:30, and I called the Audible, and I said, I'm going to drive the 35 minutes that I need to into Greenville, South Carolina, to go see Dave Matthews. Always been a fan of the jam band thing. I know Dave, some people are big fans, other people not. Their cup of tea. They don't like the yodeling that comes in sometimes. But so I call the Audible. I go there, and I'm sitting there. I'm checking my LinkedIn, and I get a nice reach out from Ken, who's also in the area, and I reply, but the connection service was so bad that you couldn't get anything out of the arena. So my message to him didn't get out until after I left the arena, yet he was in the same show that I was. So we could have had, an opportunity to, do some chanting at a Dave concert in Greenville, South Carolina. It didn't happen, but if they come around again, we'll certainly have to do that. But before then, a cup of coffee is in order for sure.
Very cool.
I'm a Dave Matthews fan. I think it's good stuff, but pretty cool story, Manus.
And then a few others on Twitter. Real Estate Rookie suggested our podcast. And then we wanted to give a special shout out to our friends and Twitter sensations. Danielle Booth, who shared some of our WeWork content this week, and Strip Mall Guy, who we got to reconnect with this week. So always good to stay in touch with the people who are posting and getting the word out there to the audience.
Thank you for all your reach out. It's always great to hear from people. It's funny that, people will come to us, and I always feel like sometimes these first emails, they come with this little parenthetical that they feel like maybe they're imposing on us. Let me assure you that you're never imposing on us. We love your questions. We love the reach out. When you ask for data, if it's easy for us to grab and it's off the shelf, we're always happy to share in it, and it's never an imposition. So keep it coming.
So Haley, I had one shout out to you this week. I was actually on a call with some fellow counselors of real estate yesterday. And to Manus's point of just people reaching out and the network effect that the podcast has created, I was on a call and got to meet Ruth Culp-Haber. She's a office leasing rep at Wharton Property Advisors there in New York. And she's a Counselor Real Estate member. And so we got to talk about the upcoming conference. And she sent me a really nice email afterwards and said that she loves the podcast. She listens every week. And her and I are going to try to meet up when I'm in NYC next time. So it's just really great. Folks that we normally would interact with but not have a connection, we immediately have a connection starting point through the podcast. So very fortunate, very appreciative. And Ruth, looking forward to meeting up and having a cup of coffee.
And Ruth, if you're worried about Lonnie showing up in that tank top, don't worry. We make sure we check out what he's wearing before we let him out.
And with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send an email to podcast@trepp.com and subscribe to the Tripwire podcast with your favorite provider. Thank you for listening and stay well.
All right.
All right.